Hi, and welcome to Edolab Markets. Today we are going to map liquidity on real charts, using Edo Liquidity Zones. A liquidity zone is a price area where the market already traded heavily and then turned. Orders were filled there, and the market remembers it. This indicator finds those areas on its own, marks each one with a box and a line, and then tracks what price does with them. Green below price is support, red above is resistance, and every zone carries the volume that built it. On JP Morgan Weekly there are 5 zones still intact, 1 that has been tested, and 4 that price has already taken out. A zone is born at a pivot, a high or a low that stands out from the candles around it. But not every pivot becomes a zone. The volume behind it has to be big enough, and that is what the volume filter decides. By default the filter is set to mid, so only pivots with genuinely heavy volume are kept. On Taiwan Semiconductor Weekly that leaves 10 zones over 3 years, not 1 on every single swing. And the box is drawn 1 average true range deep, so a zone is an area, not a single price. Every zone has 2 parts. The box where it was created, and the line that carries it forward in time. The line is what matters later, because it extends to the right, all the way to the current candle. Green zones sit below price and work as support. Red zones sit above and work as resistance. Same logic, opposite side. On the semiconductor ETF price has left a stack of green levels behind it, each one a place where buyers showed up in size. Next to every zone the indicator prints the volume that created it. That number is the average volume around the pivot, and it is the closest thing you have to the size of the flow that turned price there. The color intensity follows the same idea, the heavier the volume, the more solid the zone looks. On General Motors Weekly the deepest zones carry 70 and 80 million shares. More volume does not make a zone unbreakable. It does mean more positions were opened there, and more people are watching it. Now the 3 states of a zone. The first one is active. Active means price has not come back into the zone since it was created. The level is intact. On the oil and gas exploration ETF this red zone at 189 is still untouched. Its line runs solid to the right, waiting for price to arrive. An active zone is the cleanest reference you have on the chart, nobody has tested it yet. The second state is tested. Price entered the zone and left it without closing on the other side. That is the zone doing its job. It was reached, and it held. On Starbucks Weekly there are 2 of them, and price is trading right inside the second one. A tested zone tells you the level is real. It also tells you it has already been used. The second visit to the same area is rarely as clean as the first one. The third state is taken. A candle closed on the other side of the zone. The level failed, its line turns dashed, and from that moment it is history, not a reference. On Disney Weekly you can follow the whole cycle. An active zone up here at 122. A tested one at 120, and further down, for levels that price has already taken out. Active, tested, taken. That is the life of every zone on the chart, and the panel counts them for you. In practice you read the chart as a ladder, what is above price, and what is below. Above, the red zones are where a move can stall, because sellers were active there before. Below, the green zones are where a pullback can find buyers. On Procter & Gamble Weekly price sits between the zone at 166 above, and the one at 135 below. That is the map. Not a signal, but a set of places where something already happened, and can happen again. All of it is summarized in the panel, in the top right corner of the chart. The three counters tell you how many zones are active, how many have been tested, and how many are already taken. Below that, the nearest resistance, its price, the distance from the current candle, and the volume that built it. And the nearest support, with the same three numbers. On Chevron Weekly the nearest resistance is 10% above and the nearest support 25% below. That is the room the market has, at a glance. The behavior of all of this comes down to three settings. Let's open the panel. Pivot length decides how strict the detection is. A bigger number keeps only the more important turns. Max zones is simply how many zones stay on the chart before the oldest one is dropped. And the volume filter is the one that changes the most. Off, low, mid and high. Turn it off and every pivot becomes a zone. Raise it to high and only the heaviest levels survive. The rest is presentation, the two colors, the opacity of the boxes, the theme, and where the panel sits. Match the filter to the instrument you trade. What matters is that the zones you keep have real volume behind them. Read it in this order: the state of each zone, how far away it is, and how much volume is behind it. And be honest about the limits. A zone is a memory of what already happened, not a prediction of what comes next. If the volume filter is too strict for the instrument, you will see no zones at all. That is the filter talking, not the market. On United Parcel Weekly the nearest resistance is 2% away and the nearest support 20% below. The map is not symmetric, and that alone is useful. Edo Liquidity Zones is free and open source. You will find the full script on TradingView, and everything else on our website, www.edolab.io. Structure before signals. This is Edolab Markets, and we'll see you in the next video.